What I wanted to do to start off this afternoon of panels about the distributed solar market in the US is to just set the stage with some of the analysis that we've done on where the distributed solar market sits today. So let's ground this in both some data and a little bit of analysis of the downstream market landscape so we can see how is this market growing and who's doing it, who's installing, who's financing, who's building these projects. So I'll go through that a little bit briefly, and I'll split it out, first talking about the residential solar market and then talking about the non-residential solar market because they do function pretty much entirely independent of each other. So let's start with the residential market. I think it would be correct to say that the residential solar market has been the biggest growth story in solar in the US for the past few years. It actually hasn't been in the context of total megawatts installed. The residential market keeps growing, but the utility scale market is installing a whole lot more megawatts still today. So you heard somebody this morning incorrectly cite an even third split between residential, commercial, and utility. It's actually been about 55% utility, and the remainder is 45% split between residential and commercial. But the residential market, though it has started from a much smaller base, has seen pretty impressive, consistent incremental quarterly growth for quite a long time now, with a few very small blips in any given quarter. Back from the beginning of 2010 through today, we've seen remarkably steady national growth in residential solar installations, such that we installed 308 megawatts in Q3 2014. We'll do maybe 350, potentially even a little bit more than that. In Q4 of this year, we'll install about 1.2 gigawatts of residential solar over the course of this year. So the residential solar market is on a tear. And as I mentioned this morning, it's on a tear, particularly in California, despite the fact that the state level incentive, the rebate program from the California Solar Initiative, has expired. The thing about the residential solar market, though, is that it is very reliant on California. That hasn't changed at all. In fact, California's share of the national residential solar market has been growing over time. California alone represents more than 50% of all residential solar installed in the country. And that's been increasingly true as the California market has continued to grow, while Hawaii, which for a time was the second leading market, has started to stagnate and then shrink. So we're very reliant on California. That's not necessarily inherently a bad thing. The California solar market has enormous growth potential. Theoretically, we're not anywhere near saturation points for number of customers that are suitable for rooftop solar, but it does place increased importance on what happens with the successor program to the current net energy metering structure in California, which is currently being negotiated and will be debated and decided at the California Public Utilities Commission over the course of the next year or so. So that docket alone and the results of what happened there will probably make or break the growth of the residential solar market in this country, in addition to a lesser extent, dozens of other dockets that have net metering changes or rate structure changes built into them. But again, the residential solar market is on a tear. It is growing very, very quickly. The other trend, of course, over the past few years has been largely to do with financing. The reason, or at least one of the main reasons, that the residential solar market has seen such growth over the past few years was the advent of third-party ownership for residential solar, wherein you could offer a customer a power purchase agreement or a lease instead of them having to do a capital purchase or take out a loan for their solar installation. That was pioneered by companies like Sunrun and SolarCity and Sungevity back in 2009, 2008 in the residential market, and then it started to expand from there. And as those companies would start entering new state markets, we saw a relatively consistent trend of them basically taking over the market over the course of a couple of years, either via their installer partners or they themselves. Either way, it came such that the majority, and in some cases the vast majority of all residential installations, were third-party owned. What has been interesting there, though, is two trends that I think are worth noting. The first is that the trend line has been consistent in that it's growing everywhere, the share of third-party ownership, but the pinnacle that it has reached has not been similar. So you have some states like Arizona and Colorado where sometimes you're up over 80, sometimes 90% of all installations that are third-party owned. That lies in contrast to places like Massachusetts, also a pretty mature residential solar market, but where third-party ownership sits somewhere in the range of 60%. So it's been a majority everywhere. It hasn't been the same kind of majority everywhere. And then what has been changing just over the course of the past year or so, besides remaining in that range, is that we've started to see that market share growth more or less stagnate. So it's not that we've started to see less third-party ownership, it's just that the market share has basically remained steady. And I think more than anything else, the reason for that is that we've seen a resurgence in the availability and innovation around residential solar loans. This is something that we've been talking about for a while. It was a big prediction of ours about a year ago here, where we were saying that we thought all the major third-party residential solar finance companies would start to offer loans within their portfolio by the end of this year. And they all do now, except Vivint Solar. So if somebody from Vivint is here, if you could just introduce that in the next couple of weeks, I would be appreciative. In the meantime, everybody else has basically done it. So, and some of them have been really bullish on it. SolarCity, when they announced their loan program, publicly stated that they think it might comprise up to 50% of their installations, their residential installations, as early as next year. Whether or not that is true, the clear trend line now is growth in residential solar loans. I don't think that loans are going to overtake leases or power purchase agreements anytime in the near future, but I do think that it makes sense for residential solar installers to have both in their portfolio and be able to offer customers whatever kind of financing they want. So you're going to continue to see some innovation around the debt side of things in addition to leases and PPAs, and I think you'll see pretty much every installer wanting to be able to offer the customer whatever kind of financing they want. The other thing that's been changing over time is the landscape of companies within the residential financing space, what they do and how they structure their business. So let's start by looking a couple of years ago in 2012. In 2012, we had basically two kinds of residential solar finance companies. There was some nuance to this, but if we're categorizing broadly, there were the vertically integrated companies. That's SolarCity, certainly Vivint Solar, to a lesser extent Sungevity, because Sungevity subcontracted installations. But either way, the idea here was they owned the whole value chain. They would own the relationship with the customer, they would sell the solar, they would install the solar, they would finance the solar, they would own and operate the solar once it was installed. So that's the vertically integrated model that SolarCity in particular sort of pioneered early. Then there was this partner model, which meant you were a company that raised funds and potentially provided additional services, O&M and asset management and things like that, maybe even some customer acquisition, but you don't actually have boots on the roof. You don't actually have installers in-house. Instead, you partner with installation companies and offer them these services so that they can offer financing to their customers and so that they can compete with the SolarCities of the world. So that was the model that Sunrun in particular pioneered, and then to different degrees and with some additional nuances, Clean Power Finance and SunPower sort of added on as well. So you either had vertically integrated companies doing everything, or you had partner model companies that worked with installers but were not installers themselves. So that was the model a couple of years ago. Today it's a little bit more complex than that because a couple of things have changed. So first, you still have some vertically integrated companies. SolarCity still does everything. In fact, they are further vertically integrated than they ever were. They've now made an acquisition in Zep Solar, so they do mounting structures. They made an acquisition in Solevo, so they're going to be manufacturing modules as well. So they're vertically integrating upstream beyond just the downstream project development installation business. Vivint Solar hasn't gotten into that. They say they're not a technology company, they're just going to be installing, but they remain fully vertically integrated on the installation side. And to a large extent, Vivint considers its differentiator to be its operational efficiency in that whole process. Vivint is extraordinarily operationally efficient. Their customer acquisition costs are low, they do everything very, very quickly, they have very standardized processes and offerings to customers, the idea being that they can churn everything really, really fast. So you still have the vertically integrated model, but then now you have some semi-integrated financiers, as we would call them. This would be a company that both installs themselves, as Sunrun now does post-acquisition of Rex Solar's residential business, and as NRG Home Solar does now, having acquired Roof Diagnostics. But both of those companies also maintain a partner network. So they both install themselves and they maintain a network of partners to whom they provide basically the same services that they always did. So, the question with that is, over the long term, does it remain this hybrid model where they continue to operate themselves and then, work with others as well, or do they shift in one direction or another? I think they'll tell you most likely that this model works and they're going to continue to do both, and we'll see how it plays out over time. Then on the other side of the coin, you still have a bunch of companies, now more than ever, that are employing the partner model in one form or another. Sonova is a newer entrant, but has been gaining a lot of strides, has a relatively unique financing model that I know is going to be talked about later today. SunEdison has gotten into residential solar financing to some extent, and it's going to be interesting to see what changes there over time as SunEdison builds up its residential business. And then, of course, old standbys like SunPower and Clean Power Finance that have continued to grow and had success with their pure partner-based model. And then finally, you have the semi-integrated installer, which would be now an installer that both raises its own financing and potentially gets financing from one of the partner model companies. So this would be Astrum Solar, which has raised its own fund, but also worked with a variety of outside entities to raise financing. And Sungevity as well, to a lesser extent, because Sungevity appears to be heading more towards just working with the partner companies and being a sort of customer acquisition specialist. The point being, the landscape here is a little bit more complex than it was a couple of years ago. It's not, the delineations are not as clear as they were, or categorizations are not as clear. But you still have a lot of companies out there that are trying to pioneer and fit new models into how to sell solar to a customer and how to finance that solar, and then how that relationship should play out from inception, the first contact that the customer has with anything to do with solar, to completion, meaning the end of the project, not just the installation of the project. So there's a lot of innovation taking place around asset management as well. So that's what's changed in the third-party finance world over time. That's completely independent of the residential solar loan landscape, which is now very rapidly becoming increasingly crowded. We have pure play loan providers, so this is the corollary model to the partner model and the lease and PPA side. Companies that just offer residential solar loans and partner with installers. Sungage Financial has been around for a while. We have Sarah Ross, their CEO, speaking tomorrow morning, I think. Mosaic is now doing this, has sort of transitioned from being a crowdfunding company to a residential solar loan provider, and then a number of others that are doing it in part or in whole for their business. We have national banks, some of which have been offering residential solar loan programs for some time through their installer partners or through other partners, are continuing to do so now and are in competition with these pure play loan providers. And then we have companies that do leases and loans, right? So the companies that had been just offering leases and PPAs now have added loans to their portfolio, and even some module suppliers figuring out ways to provide value-added services to their installer partners via financing programs like loans. This was something that actually we expected to see happen more with leases and PPAs. Didn't happen a whole lot. The suppliers, technology suppliers, providing this value-added service by raising a fund and offering it through installer partners. Certainly SunPower has been doing that for years, and many other module suppliers and a few inverter suppliers thought about it and then never took the plunge. Now we're starting to see it happen some. And then finally, though this is not necessarily in direct competition, what you do have in the loan space that you don't really have in the lease or PPA space is state entities that offer some generally relatively limited loan program to residential solar customers within their own state, within their own territory. So in addition to a more complex third-party ownership landscape, we now have this residential solar loan landscape that is burgeoning. And in fact, we see announcements all the time now. Astrum Solar just announced a new fund with Hudson Clean Energy Partners, I think last week, to do a whole bunch more residential solar loans as well. This is a pretty hot space. It's hot like residential solar leases were a couple of years ago. And so then separately, apart from the finance landscape, we asked the question, who's installing all this residential solar? Well, here's who it was in 2013. This is looking at the first half of 2013 because that allows us to compare apples to apples against the first half of this year. The first thing to note here is that we hear a lot about a small number of companies, and certainly we're guilty of mentioning this small number of companies a lot because it's been really impressive to see the growth of companies like SolarCity in the market. But there is still a very long tail of residential solar installers in the US. There are still a lot of installations being done by installers that in aggregate will do well under a megawatt over the course of the year. In the first half of 2013, the top 5 installers, it's the top 10 installers only accounted for 45% of the market. So 55% of the market was comprised of significantly smaller installers. That's still a pretty diverse landscape. What has the trend line been? Well, it has been towards consolidation to an extent. So the largest installers have not only been growing in a growing market, but they have been gaining market share. SolarCity installed almost a third of all residential solar in the first half of this year. SolarCity and Vivint alone accounted for 44% of the market. And so the top 10 jumped from 45% of the market to 60% of the market over the course of a year. So that is clearly a directionally trend line toward consolidation. But it's misleading to just sort of look at that and take away from it that the big guys are the only ones who will survive, because actually the little guys are growing also. They just haven't been growing as fast. So the top 10 solar installers from the first half of 2013 to the first half of 2014 grew 85%, whereas all others in aggregate grew 11%. In other words, everybody's growing. It's just the rate at which you are growing at this point that is dictating changes in market shares. It's not necessarily a bad thing. It has to do with how you're trying to scale and build your business. And it also, I think, doesn't necessarily portend poorly for the smaller residential solar installers. It was an interesting vote earlier this morning about whether over the long term we'll have a large number of small installers, small number of large installers, or a mix. Right now, I think it looks, right now it's definitely a mix, and I think that directionally it looks like it's going to remain a mix for some time to come. So let's switch gears and talk about the commercial market, where we have a very different dynamic at play. Remember, the residential solar market has been steadily, incrementally growing for 4 years now plus. The commercial solar market has not seen the same trend line. In fact, the commercial market overall, with some peaks and valleys, has basically been flat in terms of megawatt installations for the past 2 years. The commercial solar market grew 3% in aggregate in 2013. We think it's going to grow about 0% in 2014. And so as you can see, where there was a bunch of growth through 2011, it then kind of flatlined. So why did that happen? Costs continue to fall. All the things that are true of residential are largely true of commercial. But the problem is a couple of things. First, the economics are tighter in general. You don't have nearly as much margin room in commercial as you do in residential. And so the commercial market has been a lot more reliant on the availability and the economic viability of state-level incentives than the residential market has. And so you've had a few individual state markets for commercial that were a big part of that growth story through 2011 and into 2012 that no longer are. New Jersey, of course, being the biggest example here. I showed it this morning. The New Jersey market saw a gigantic boom bust as a result of the SREC market going into heavy oversupply after a big build out in installations. So that alone has had a big impact on the commercial solar market, but it's not just New Jersey. Actually, California has been relatively flat since then as well. You saw a big build out of school and government installations in California post-stimulus funding. But once that started to expire, the market didn't grow accordingly. And as the production-based incentive, the PBI in California, has declined, the market has not continued to grow like we have seen in the residential space. So it's a tougher landscape. One of the reasons for that, I think, one of the biggest reasons for that, is that we remain, as an industry, really, really bad at installing and financing small commercial solar. Small commercial, in theory, is an enormous market. It has a huge market potential for solar in the US. The problem is it's really hard to finance. In the residential space, you have FICO scores that you can finance against. That's pretty simple. In the large commercial space, either you might have an entity that has bond ratings that you can lend against, or you can absorb the transaction costs from doing the diligence on an individual project because the project is big enough. Small commercial sits in this niche that really almost nobody has been able to figure out how to crack. And so we've actually gone further and further away from it over time, where in 2010, projects over a megawatt comprised about 30% of the market. Now they comprise over half of the market. And accordingly, smaller projects have comprised a smaller and smaller share. Basically, we haven't grown that market at all. So while we've seen some growth in the larger scale segment, small commercial, anything under 500 kilowatts, we haven't seen any growth in 4 years. There have been various solutions proposed to that. There have been companies that are trying to pioneer things like online marketplaces for commercial solar, or scores that you might be able to create that would then convince a financier, okay, I can get comfortable with the score once, and then once I know the score, I will finance against it. That's great, but it hasn't seen the kind of uptake that you would need in order to grow the overall commercial market. So that's been a challenge for commercial. The other thing that I think is a challenge for the commercial market is that where the residential market is relatively straightforward, even when you have a couple of parties involved, like an installer and a finance provider, the commercial landscape is pretty messy, and you can end up seeing a single project go through a bunch of different owners of different types. So an example would be you can have two guys in a credit card, is a good way to put it, for a lot of origination of commercial projects takes place by people who are not big solar installers or developers or EPCs. They just happen to have a relationship and they originate a project, at which point they sell it to a small developer. The small developer does some of the early development work, but when it gets time to need construction finance or some of the later stage finance, they can't afford it, so they sell it to a bigger developer or an EPC who then can actually build it out but doesn't want to own it over the long term, so they sell it off to a long-term owner. That's not uncommon in the commercial solar market, especially for larger commercial projects. That makes it kind of messy. There's a lot of transaction costs in there. There's a lot of market inefficiencies in there that make it so that you just don't scale as quickly. You can have another model where there's an early stage developer who develops the asset from greenfield, sells it to a late stage developer who has their own construction finance, who ultimately sells the project either to a yield co or to a private equity owner who's going to hold it for the long term. So on the yield co side of this, for example, SunEdison has been out going around and basically trying to buy up anything that they possibly can to fill Terraform, their yield co, because they need growth within there. That's why they've made so many acquisitions, right? And that drives up the bid price on projects, which is good if you're an earlier stage developer, but it doesn't necessarily make the projects more economic. So I was looking around for an example of this, and I found a project in Massachusetts that went through 2 transactions over the course of 2 months last year. It was developed by a company. It's a 6 megawatt project in Dartmouth, Massachusetts. That's a big project. It was developed by a company called No Fossil Fuel LLC, which is a perfect example of the 2 guys in a credit card type of a company. This is No Fossil Fuel LLC exists. They have, I think, 3 or 4 assets. They have like 1 wind project in Western Massachusetts and 2 solar projects that they built, or developed rather, sold all of them off, probably made a pretty penny on it. If you want to get into somewhere where you make a lot of money in the solar business, just go originate large commercial solar projects and sell them. Sold it to Amoresco, which then sold it to Sincarfa Capital, which is a private equity firm, just over the course of a couple of months, so presumably at a premium each time. So the commercial market, not to be too negative on it, there's enormous potential for commercial solar in the US, but it is faced with a whole set of challenges that I just don't think you see in the residential market, and has made it harder to scale the commercial market up. And so I think one of the challenges that'll be interesting to talk about in some of the panels this afternoon is, how do you get past that? How do you finance small commercial solar? How do you reach scale? How do you get past the need for big state level incentives in the commercial space to make sure that 2015 is a resumption of growth? Because the commercial market would have a really hard time with another flat year in 2015. So where's the market headed? This is our forecast for the next few years of solar, distributed solar in the US. The first thing that you'll note here is we came from, in 2008 and 2009, commercial solar was a little bit bigger than residential solar on an annual installation basis, but then commercial was what took off in 2010, 11, 12, and then started to stagnate, as I said. Meanwhile, the residential solar market came from a smaller base, but has been building extraordinary momentum. So we are reasonably confident that when the numbers are all counted, 2014 will be the first year in a decade that we see more capacity installed in the residential market than in the commercial market in the US. And We could be wrong, but we think it's going to remain that way for at least the next few years. That said, there's growth to be had in both segments. There is meaningful demand, certainly up through 2016, and then if you believe us, there's a decline in 2017, but it doesn't entirely eviscerate the market, and then you see a resumption of growth thereafter. So there's lots to be excited about, but there are also some major challenges, and that's why I think this afternoon's sessions are going to be exciting and really interesting. So thank you very much, and I will hand it over to Stephen for a panel on tomorrow's DG compensation.